Welcome to today's interview. I'm your host, Claudia Merkert from BullionStar, and I'm thrilled to be joined by Peter Krauth, one of the most highly regarded experts in the precious metals sector. If you're serious about silver and gold, chances are you're familiar with Peter's work. With decades of experience as a resource market analyst, Peter has a deep understanding of commodities and precious metals. He's the author of The Great Silver Bull, and as the editor of Silver Stock Investor, Peter has earned a reputation for providing actionable insights on silver, gold, and the macroeconomic forces influencing the metals markets. Peter, welcome. It's a pleasure to have you with us at BullionStar.
Thanks so much, Claudia. That was quite the introduction.
Thanks for being with us today. Peter, I'd love to start our discussion by talking about inflation. At the moment, the inflation narrative seems broken. The official CPI data suggests inflation is cooling, yet gold has recently hit all-time highs. Is this a sign that the market has stopped believing central bank metrics, or are we just in a new phase where inflation hedging is about more than just CPI?
So I do think that the market is sort of calling the Fed's bluff in terms of reporting on inflation numbers. There are a few things. If we talk about gold, for example, and what's been driving it, the last couple of years have seen massive buying by central banks. They are looking at what has happened, especially since Russia stepped in and started, its war with Ukraine. And then the US decided to put sanctions on Russia and freezing its assets, for example. The rest of the world looked on that and said, well, we don't want to get caught the same way. And one great way around that is to own gold and to use that potentially to settle accounts and to transact and so on. So that's one thing that's been driving gold. But if you look in probably the last couple of quarters or so, one of the things that has been driving gold, in addition to all of this physical buying by central banks, has been these elevated levels of inflation. If we talk about the Fed, which is sort of the most influential of central banks globally, they have constantly said that their target is 2%, and yet we've barely been able to get below 3%. So that's almost 50% above their target. We've seen those levels hover around there, and yet things like producer price index has stayed elevated. We've seen a lot more buying by retail investors of gold, for example, that have gone to places like Costco, are starting to buy from Walmart, for example. And, Costco is doing about $200 million in sales of precious metals per month. It's just incredible. So the average retail investor is starting to clue in as well. They're looking at these inflation numbers and they're realizing that they just don't make sense. They're not adding up for them. If you look at your expenses in your daily life, we're not anywhere near to say 2.5% or 3%. So retail investors and professional investors have really come to terms with the fact that we are in a new paradigm, a new environment, that inflation will stay elevated for probably the better part of a decade going forward.
Interesting. So do you think, based on that answer, then, that inflation is now a structural issue, driven maybe by factors like supply chain deglobalization, resource nationalism, and an ongoing deficit spending, rather than just a temporary cyclical problem?
Absolutely. I do think that it is a baked in kind of structural problem. As they say, history rhymes, but doesn't necessarily repeat. And I think the best analog we have is the 1970s. We saw what economists thought could not exist, which was a weak economy and high inflation. And yet the 1970s proved them wrong. That's exactly what we had. And I think that is the best analog that we have for the last few years and the next several years. And now with all of these tariff issues, with the deglobalization that we've seen post-COVID, post-Russia-Ukraine war, with the world becoming polarized and different areas saying, well, it's funny. You'd think in the West, up until maybe a few months ago, the West probably thought, well, okay, so, we can interact and we can count on each other. Well, the last few days and weeks with what's happened with Trump and the tariffs, even that's been blown up. So all these alliances have to sort of be reworked and renegotiated on an almost overnight basis. So it's normal for sure that if We don't have the globalization. We can't depend on what we had with these supply chains, et cetera, set up prior to, let's say, COVID, for example, that naturally the world has certainly morphed towards becoming more independent internally and with maybe nearby partners and allies. And that has certainly added to costs for everything. And I could go on and on in terms of the kinds of things that are going to add to inflation as we go forward. But we are absolutely in a new paradigm, and inflation will stay elevated with all of these issues weighing on prices.
Yeah. And so we talked a little bit, we touched on gold and silver before, and I want to just talk about its role in inflation. As we've mentioned, gold has been hitting all-time highs, but silver is still far from its peak. So if silver is a monetary metal, why hasn't it followed gold's rise? And is the market undervaluing silver, or perhaps has its role as an inflation hedge changed?
Silver still is a monetary metal. The thing is that it is less of a monetary metal, and gold is almost exclusively a monetary metal. Something like less than 10% of gold is used for different kinds of things that are what you would consider non-monetary, things that are, let's say, industrial type of applications. Instead, for silver, it's a much higher percentage. 10 years ago, about half of silver was used in industry, and that has actually become closer to about 60% in recent years from about a decade ago. So as time has moved on, as I say, in the last 10 years, more and more silver is consumed by industry, and less of it is so-called available for investment purposes. Think about why that is. One of the important things that we've seen is solar has become so important in the demand for silver, to the point where now it consumes almost 25% of the annual mine supply of silver, which is about 85% of all of the silver that we have available every year comes from mining, and more than a quarter of it goes to just that one application. It's incredible how much silver solar actually soaks up today. So if you think about how the silver market has changed, where about, as I say, 10 years ago, half was industrial consumption. And I like to combine things like silver bullion, coins and bars, things like silver jewelry and silverware. And I combine those together to simplify how I look at the market. And that, for me, makes up mostly the other half of silver demand. Well, today that has shrunk to, as I say, about 40% of the silver market, where the rest being industrial. What's interesting is that what we do know about silver investment, in other words, the monetary side, is that it ebbs and flows. And right now, I think for a little while, it's been ebbing. When it flows and it comes back in a really strong way, that's what really, really drives volatility, especially upside volatility. And here's something interesting to consider is that we've gone from maybe 10 years ago, 50% of silver going to investment demand. Today, because industrial now takes about 60%, that leaves about 40% for investment demand. So think about when that demand starts to come back in a very big way, that now leaves a smaller portion of the overall silver supply every year to go to meet that investment demand. And that's what I think a lot of the market is missing. When that demand comes back in a big way for people who say, I need to get my hands on some physical silver, there will now be less available each year. And that'll help drive the price up higher and faster.
Okay, I just want to circle back now just to talking about silver as the monetary asset. So central banks are stockpiling gold at record levels. So if silver were viewed as a monetary asset, wouldn't they be doing the same with silver? And why are they not?
Yeah, so that's an interesting question. I mean, a long time ago, silver was used as money. Perhaps I shouldn't say a long time ago. Up until about the 1970s, many nations were still using silver in their coinage. So technically, in that sense, it was money until 50 years ago, late 60s, 1970s or so. But most central banks did not sit on large supplies of silver the way that they do gold. It is a lot bulkier for the same value as gold. And you need so much more silver to represent the same value in gold. I honestly do not see any kind of reasonable argument for silver to become some kind of a central bank reserve asset. That being said, Russia last fall did say that they were going to start to add silver to their reserves, along with, I believe it was platinum and palladium, and of course, gold. That's an exception. But I think that part of it was a little bit more strategic. And that's something that we've certainly seen more and more in the last sort of year or so, or couple of years, is that there's been this ongoing push by different participants, and especially on the mining side, to have silver declared as a strategic metal by various governments, especially in the West. A lot of silver goes into military applications. We have almost no data on that. I don't think that's an accident. I think that those consumers for the military applications really prefer us not knowing how much silver gets consumed on that side of things. As far as silver being, some sort of a reserve asset, it's just not practical. And it's also a much, much smaller market. So there is a lot less silver available every year. If you look at the value of it versus gold, it just simply makes more sense to stockpile gold rather than silver for a central bank.
That makes sense. I mean, my next question to you was going to be what you thought it would take for silver to be recognized as a reserve asset again, but I think you've just answered that question right there.
Sure.
So yeah, is it going to be price related? If the gold silver ratio were to, for example, come back down, could you imagine there would be a scenario in which silver could be potentially recognized as a reserve asset again?
I really don't think so. Although they stockpile gold, we have a hard time having central banks admit, so to speak, that they see gold as a reserve asset. They'll tell you things like, oh, it's tradition, it's this, it's that. But it's clear the way banking rules have changed globally. We've seen with banking rules, Basel III, I think, has shown that I think this year, in fact, it'll apply in the US, that gold will move from a tier 3 to a tier 1 asset. So it's going to be now considered on par with the safest treasuries, for example. That's a very big step. And I think we're going to start to see regular banks, actually not just central banks, start to add gold to their balance sheets. To find arguments where we could see something similar happen to silver because of its volatility, because of its much smaller market, I would have a hard time envisioning that kind of scenario.
Yeah, it's certainly interesting times for precious metals ahead. We're living in interesting times for our industry.
Sure.
So I just want to move on now to talking about the US dollar. Despite the ballooning US debt and de-dollarization narratives, the dollar has been really resilient. Do you think we could be in the final melt up in the dollar strength before a rapid collapse, or do you think we need to rethink the idea that the dollar's in real danger?
I think it's probably somewhere in between, frankly. I do think that it's going to be a slow grind lower. You'll have your peaks and valleys, and you'll have some volatility. We've seen that quite a bit actually lately. US dollar index has moved where you get these moves of 3, 4, 5% in a matter of weeks or months, which is very atypical for a large global type currency. So the volatility certainly is there. But I do think that you're still going to have over time countries and large corporations and even smaller companies that trade with others being more than happy to settle in the dollar because it really has such tremendous liquidity and recognition. And it's so readily accepted all over the world. And you still have so many commodities priced in the dollar. So in that sense, I think the dollar's position will stay relatively dominant, but it will continue to kind of grind lower over time. When I look at charts of the US dollar index, for example, it peaked in the mid 80s, around 125, 130. It peaked again around 2000, around 110. I think it's actually peaking right now somewhere close to 105, or recently peaked near 105. It dropped off to about 100 or so. We're right now back around 103. But I think, especially given, events of the last few days and weeks and months in the US, and if you look at history with Trump as president in his last mandate, this is exactly exactly how it played out. The dollar peaked soon after he took office and then started to roll over and got weak. And he's very vocal about wanting a weaker dollar. And, that's good for him and his businesses. It also encourages U.S. exports because they become cheaper. So there are a lot of reasons why both Trump wants a weaker dollar and why I think sort of fundamentally it's heading that way anyways. And especially, like I say, events of recent weeks are just going to push the dollar lower. There was a really interesting chart that I saw a few months ago, and it showed the relative importance of different currencies, larger currencies worldwide. And that included, let's say the Swiss franc, obviously the US dollar, the pound, the UK pound, the Australian dollar, the Canadian dollar, the Japanese yen. It also included the euro, and it included gold. Well, what was interesting was for the first time ever, gold has now surpassed the value of the euro as a reserve asset for central banks around the world. So that's also very telling. And in the last sort of 10 or 15 years where we've seen that gap close, we've also seen that the US dollar's role as a reserve currency on central banks' balance sheets has also started to shrink, where it was sort of I believe it was maybe 15 or 20 years ago, was mid to high 60%. Now we're somewhere around the low 50%. So I think that's what we're going to see. We're going to see it continue to grind lower. And as we talked about, the world becoming more and more polarized, different areas are going to trade with each other, and they will find ways to avoid, having to transact in the dollar.
Yeah. And so then just on that note, if we are moving towards multiple currencies instead of just relying on the dollar, what role could gold and silver play? And do you think we could see countries using commodities like gold, silver, oil, and uranium to settle payments directly instead of using traditional currencies?
Absolutely. I mean, I do think that's what we've seen happen to a fair extent. If you think of, the sanctions on Russia, for example, if you think of sanctions on Iran, for example, it's quite certain that area of the world has managed to get around issues with using dollars, for example, to settle trades and either outright bartering of commodities or simply using gold as a quiet sort of currency where they can just use that to settle trade payments and they don't need to worry about having to go through the banking system. That being said, I do think that we're going to see these blocks start to form and become more obvious over time. Many of your viewers probably know of the BRICS that are now expanding. As I say, I still think that we're a long way off from the dollar losing its sort of global dominance, but it is going to become less and less important over time. It's one thing for these countries to use gold, for example, to settle transactions, to settle trade when they're under pressure. But I do think that we're going to continue to see gold prices rise. And as the value of gold rises, I think we're also going to see countries and investors and average everyday consumers add to their gold holdings, to their stashes. Gold's going to take on more and more importance when it comes to it being viewed as a currency of some sort. It may be unofficial, but I do think it's going to be a larger and larger portion of people's portfolios.
Yeah, interesting. Now, I know that silver is your specialty, Peter, so I just want to focus a bit more on that if we can. Let's talk about the silver market supply and demand. The silver deficit continues to grow, yet prices remain relatively subdued. Is it just paper market manipulation, do you think, or is there a hidden supply source keeping the physical market balanced?
This is something that I started to address a little over a year ago. As we know, silver first sold off, corrected really hard at the beginning of the COVID pandemic. So in sort of March of 2020, went from about $16 to $20 and then rallied like crazy up until right into August where it hit $30. And then since say August of 2020, it's been in this range. I'm going to say anywhere from about say 22 to 28, $30. And then we broke through that last year in October. It rallied to about $35, had pulled back. We recently touched $35 again, just a matter of a few weeks back. And we've had a pullback again in recent weeks, again, on the back of, I think, this tariff news. So when I started looking at why silver would be trading with sort of a cap or a ceiling on its price when you've got these structural deficits that have been ongoing for the last 4 years consistently. Supply is about 1 billion ounces a year. So about 850 million ounces of that, or 85%, comes from mining, and the other 15% roughly comes from recycling. But supply is about 1 billion ounces a year. And yet, for the last 4 years, on average, demand has been about 1.2 billion ounces per year. So we're looking at a 20% deficit every year for the last 4 years. And yet, if you're looking at this market, you ask yourself, how could the silver price seem to be capped at, say, $32 or so with ongoing structural deficits? Then I started looking at where are what we call secondary above ground silver supplies. And you have large inventories that sit on mostly three large exchanges: the Shanghai Futures Exchange, the LBMA in London, and then the COMEX in New York. And the LBMA is certainly by far the largest of the three. What has happened is, and I started to do the research, look at the charts, and in about early 2021, we started to see, first gradually and then much more quickly, the inventories at these exchanges drop off. I asked myself, okay, so what was going on? These are the kinds of things that you have to make assumptions about. But for me, the most logical explanation for that was that you had consumption and demand of silver continue to go up and stay up consistently high. So for me, the conclusion was that you had large industrial consumers mostly, and a lot of that driven by the demand from solar, requiring physical silver. So they would be able to go buy a long futures contract, meaning a contract where you expect the price to go up. And when that contract matured, they would go to the exchange and say, okay, my contract is now up. I would like to take delivery. Now, the Shanghai is built for that kind of mechanism, but the other two, the LBMA and the COMEX, are not built for that. They were not meant for that. They were just meant for hedging and so on with futures contracts. Well, lo and behold, as I say, if you look back from about early 2021, inventories have come down, depending on which exchange, to the tune of 40 to 70%. I came to the conclusion that what that meant was you could have large consumption of silver being met by going to these exchanges, taking delivery of physical silver, because you had these stockpiles of silver, so they could draw down on already stockpiled silver without having to put pressure on bringing new additional supply to market from mining or from recycling. Well, after I expressed my conclusions about what was going on and why this may be limiting temporarily the upside on the silver price, there was a fantastic report by TD Securities almost 30 or 40 days later that said essentially the same thing. And they were saying that they had the conclusion I had, which was that this could go on for about maybe 12 or 18 months at the current pace. And after that, we really would dry up this secondary supply of silver. Basically, the large consumers would start to put a lot of upward pressure on the silver price because they wouldn't be able to meet those demands from existing above ground supply anymore. So sorry for the long-winded explanation, but
I get it. So what you're saying is mining output isn't keeping up with the industrial demand due to things like solar and EV technologies. I guess my question to that is, are we approaching an inflection point where industrial users are going to be forced to compete with the investors for a shrinking silver supply? And what does that mean for the price of silver?
Yes. So my answer to that is yes, absolutely. The pushback I get from when I have these discussions with colleagues and other people in the industry is they'll say there's lots of other silver that's held above ground, and it's true. Silver and gold, a lot of it is held by private investors. They have their own stockpiles and so on. And so they'll say, well, if we get to that point, a lot of this additional silver, which we can't quantify. We can quantify what's on the exchanges, but we don't know how much silver really is held. We can make estimates. It's maybe a few billion ounces is held privately. And their argument is that this silver will come to market and it will meet some of that demand. And my counter argument is that yes, however, at what price? And so I don't believe that silver, which is very tightly held, will come to market at, say, prevailing prices. I think it'll come to market at much, much higher prices. And by that, I mean, $40, $45, $50 is what it's going to take to get some of these private holders of silver to let go and to sell it back into the market and to satisfy this demand that really is not being met any other way. So investors of physical silver will absolutely be competing with industrial consumers, and all of that will drive silver higher.
That's great. Thank you, Peter, for that explanation. Let's move on to talking about the inventory flows of silver. Recently, there's been a significant flow of silver from London to New York, possibly to meet COMEX demand. Is this a sign of physical stress in the US market, or is it just logistical reshuffling going on?
I think what has been going on there is, for the most part, and this we've seen start to happen since November or so, and that was when Trump started talking about tariffs. And we had no idea what the tariffs would apply to, who they would apply to, etc. I believe what happened was you had participants in the market, in the US specifically, where if the tariffs were applied on imports, which is what we're talking about generally, imports to the US, that if they had to come up with a lot of silver and gold to meet deliveries, that they would have to do it at much higher prices because of potential tariffs. So I think that's the consensus, that really what has happened was we've seen these outsized flows of gold, of silver, come to New York mostly from London, some of it from China as well, to meet this potential demand in case tariffs got applied against silver. So, because that would have sunk plenty of institutions if they had to, from one day to the next, have to go out and buy silver and pay 25% more because of tariffs to meet a contract. Interestingly enough, especially in the case of gold, I believe that was a lot of the premium that got built in. So in other words, from let's say November until last week, both metals moved up considerably because the market thought this was a serious risk and it would take silver and gold at these higher prices to be able to meet that demand. Now, some of that risk has gone away. And we know from lists that were published from the White House, gold, silver, several other base metals and other things have been completely exempt from the tariffs. Interestingly enough, silver has backed off a lot more, to the tune of about, I think, 12 to 14% since these tariffs were announced last week. Gold has backed off, but has stayed relatively high despite that. We're still below about $3,000 US, but still, it has held up really quite strong. So I think that we had a bit of buying the rumor, selling the news, and when the news came, the market said, okay, these tariffs don't apply. So it was overpriced and there was too much of a premium built in. But I do think that we've seen lease rates stay high on silver. We've seen EFP premiums, exchange for physical premiums, have stayed high. And so both of these things speak to serious tightness nonetheless in the silver market. I'll give you a small anecdote, and this is from already about a year ago. This was a mining executive who produces overseas, produces silver, only silver, and sells about half of their production to China and about half to the West. And he was telling me that the silver consumers would come to them and say, we are prepared to pay you up to $4 over spot. We are prepared to pay you 2 weeks in advance. We absolutely need to secure this supply of silver. And I believe a lot of that is destined for solar. As I say, it's anecdotal, but it certainly speaks to the kind of tightness that we've had in the market. And as these secondary inventories get whittled down, I think that we're going to see the silver price bump up. And think about, kind of what's happened over the past year. In February of last year, silver was about $22. And then very soon after, it started to rally very strongly. So from about February until October, it went from about $22 to $35. That was a 40% gain in a matter of about 7 months or so. And I think that was the market coming to terms with the fact that this secondary supply to meet serious ongoing demand and meet these structural deficits really could only go on so long. And we've certainly seen silver back off off. It rallied again. It's backed off again. But I think that a floor somewhere in the maybe $28 US range is about where it's going to be. And I think it'll hold up quite strongly from there. If you look at maybe what has weighed on silver recently, besides, this market crash, it's industrial application, because so much of it is now used industrially. If the market obviously is forward looking, and if there's some kind of, economic recession and slowdown and so on, the risk or the concern is that there'll be less demand for silver. And what we've seen in the past, especially through the financial crisis and then COVID again, is that governments very quickly step in, stimulate the market, have all kinds of programs to get things going again. They print money, but they have infrastructure programs, stimulus programs. Some of the easiest sells are green economy type of programs, infrastructure, and a lot of this requires a lot of silver. And that's why I think that any kind of a serious sell-off in silver is probably overblown. I think that its floor is relatively high given the tightness in the market. And we've seen Europe, for example, saying, hey, we have to spend upwards of $1 trillion over the next several years for two things. One is for rearming. Western Europe is concerned about Russia, for example, and for green energy programs. So, I honestly do not see very, very big downside for silver. And one last thing, Claudia, I looked at some charts. This was about a year ago, and I thought to myself, I had seen a similar chart for how gold behaves when you get rate cutting cycles by the Fed, for example. And gold performs very well almost as soon as Fed starts to cut rates. Well, silver performs even better, but with a lag. You can see these things in hindsight, but when the Fed embarks on a rate cutting cycle, when they are about halfway through, silver starts to take off. And in the last 3 rate cutting cycles, silver was up over 300% on average over the next 12 to 18 months or so. So silver, just absolutely explodes when we're in that kind of environment. When recession hits, probably next couple of quarters, the Fed and other central banks will absolutely return to cutting. And they'll do that, by the way, in the face of high and probably rising inflation. And that will kill their credibility, right? Because cutting rates in the face of rising inflation is going to tell the market they've lost control. They really have no more choice. And again, this is rocket fuel for both gold and silver.
Yeah, I want to talk more about silver's performance, but I just want to ask you one more question. I'm wondering what you make of the wide gap between the spot and futures price and why it's not closing.
Yeah, I think you've got the market appreciating that having the silver in hand is very valuable, more than ever. And with these kinds of concerns, the risk of tariffs has technically gone away. It's almost worthless listening to the news these days because these things change almost overnight. I kind of joke about that with my wife, it's like, okay, so this is what we're hearing today. 10 minutes from now, it might be completely different. Tomorrow morning, it'll be completely different again. And so what do you base your decisions on? And so I think that's really the market saying that having the silver in hand right now has a premium to it, and future delivery has a big question mark on it. Supply is very doubtful. We're prepared to pay more to have that in our hands right now. And I think that kind of helps to explain that gap.
So better to have the physical than the paper.
That's right. Yeah. More than ever.
All right, let's talk a little bit more about silver's performance of late. Given its role as an industrial and monetary asset, as we've discussed, which force do you think it's driving its price action more right now, the monetary fears or the industrial demand growth? And what outlook do you see for the short to medium term in this regard in light of the talk of impending recession?
So we addressed some of that, but I think that if we look at the last 2-3 weeks or so, I do think that it's been concern about potential recession, economic slowdown. It's almost as though silver was sniffing out what happened in the last week or so, saying to the market, we're due for a slowdown. And certainly that to me says that it's the industrial side of it that is driving the silver price right now. I do think that that is probably a little bit overblown. I do think that we've seen it in the last couple of crises, that the stimulus is very, very favorable for the outlook for silver. The way silver has behaved when we got rate cutting cycles just shows that it can be very much explosive when we get about halfway through these rate cutting cycles. So I think it is the industrial side that's been driving it. I do think that that's overblown. And something to keep in mind too is that gold's at, say, $3,000. Let's call it $3,000. And for the most part, I think that retail investors really have not caught on. They're starting to, but they have really not caught on. I don't know what it's going to take. I don't know what price level or what news is going to be required. But at some point, they will absolutely become very interested in gold. I think that it's always gold first. Gold is the king. And when they see gold at 3,500, for example, whatever that driving point, that price point is, and the retail side gets excited about gold, they're going to look at gold and say, wow, that is really pricey for 1 ounce of gold. What are my alternatives? And at that point, who knows? Silver may be $40, $45. That's still going to look dirt cheap compared to gold. And I think that that's what you get is this FOMO or fear of missing out. The sort of smaller investor is going to see gold, feel like they've been priced out of it and say, wow, silver has a lot of upside. It has a lot of runway. It has a long way to go relative to gold. And then they'll perhaps look at things like the gold silver ratio and realize that the upside is tremendous. And that will start to drive much, much higher silver prices.
And we've seen some volatility in the stock markets in the last week, particularly. And do you think that the drop in silver and gold prices has been in response to that? And if so, how far do you think gold and silver might be pulling back before they continue on going to further highs, as my understanding has it that you believe they will?
Yes, absolutely. I do think that they've been dragged down, so to speak, with the market sell-off. And if you look at what's happened in the markets, we've seen full-out bear markets. The larger US indices have already bounced from that point, but that's pretty incredible when you think that within a matter of a couple of months, maybe, that we've had this kind of a dramatic sell-off. If you consider, compared to gold and silver, how the precious metals have held up in relation to what the broader indices have done, they've really done a reasonable job in the case of silver and a fantastic job in the case of gold, protecting purchasing power versus
absolutely.
US stocks, for example. They have been dragged down. That's inevitable. You also get some investors who get margin calls. They need to sell what's up. They need to sell what's liquid. These are metals and investments that have been up and are liquid. They get sold off to help meet those margin calls. And that could be internally for a fund. That could be for an individual investor. But I think that that's why we haven't seen quite the same pullback in the metals as we have in the stocks. And again, that speaks to their resilience.
Absolutely. Peter, I would love to hear about your fantastic work a bit more. In your book, This is the Great Silver Bull, you lay out the case for a historic silver breakout. Now that we're in 2025 and silver has started to move, do you think we're in the early innings, or has the real opportunity already passed?
Despite the reasonably strong gains we've had, and if you look back in 2000 or 2001, silver was $4. We've been at $50 since then. In April of 2011, we're now somewhere around 30. And in the last couple of quarters, we've been already at 35. 50 is a relative number because if you were to use government statistics, when silver hit $50 in April of 2011, that would still be $65 today. We're still at half of that level. If you look at $50 in 1980, it would be north of about $145. So on inflation adjusted pricing alone, it is still very early innings. If you look at silver versus gold right now, the gold silver ratio, we're at almost 100 to 1. That too shows that if you look at the last 20, 30 years, on average, silver has been about 55 to 60 versus gold, silver ounces to one gold ounce. And so at 100, that suggests that silver is still very, very cheap. So yes, in the book, I make my case for how I think silver could ultimately go to about $300, in a mania phase in this bull run. And when I wrote that, I thought, am I crazy? Are others going to think I'm crazy? And now I'm hearing high-profile investors talk about those targets and even higher. And the way I get to those numbers are by making certain assumptions, but also using all kinds of indicators that go back to the 1970s and when silver peaked in prior bull markets. If anybody wants to read my rationale, it's in the book. And I looked at a potential peak in the silver price, and I got to in the $300 range using different indicators. So I do think that it's a realistic target, but as I say, at some blow off peak in a mania phase. So that's a lot of upside from here.
That's exciting. I don't want to put you on the spot, but do you have a time frame of when you think we could be looking at $300 pricing for silver?
Yeah, I think that there's a lot of runway left in this bull market. Some people are talking about 5 years, 6 years. I actually think it's going to take longer than that to play out, but I also think that both metals will go much higher than the average person could even imagine. When I made my assumptions for $300 silver, I was actually one of them to use the gold silver ratio, for example, and other indicators. I used $5,000 gold. I have been calling for $5,000 gold going back to 2009. For the last few years, realistically think that we're going to see closer to $10,000 gold. Some are calling for even much higher than that, and they have very good rationale for it. And we're talking about very, very well-informed, well-researched opinions and credible analysis that suggests that we could reach 10 or even higher $1,000 in gold. So again, I think that it's very realistic, but I think that we could get into an investment environment, an economic environment where gold and silver reach these tremendous highs, but there has been so much inflation of fiat currencies at that point that those highs will not be as impressive or as meaningful as they might sound today. You have to consider these things in context. If I look out, it could take 5, 10 years to work out to these kinds of peak prices of these metals. And frankly, I'm not sure that they would necessarily have massive corrections after that. I think we could be in a completely new global economic environment where precious metals, if they don't have an official role, have a de facto role as money, that will support these really high prices potentially for decades.
Interesting. Now, Peter, you're also the editor of a newsletter, Silver Stock Investor. Could you tell us a bit more about that, and can you highlight for our audience one under the radar trend in the silver market that investors might be missing right now?
So Silver Stock Investor is my flagship newsletter. I started that 4 years ago, and it really talks about silver stocks and everything in the whole silver space. Sort of the one area that I don't really deal with is the silver futures market, but I talk about physical silver. I talk about physically backed silver ETFs, for example, and then silver mining ETFs. And then I go through everything from the large cap royalty and producer companies all the way down to the junior explorers. So that's a weekly letter that I publish. Really, it's very much news-based. It's clarifying, analyzing, and commenting on news on the companies that are in the portfolio in the newsletter. And I also provide proprietary research, things that I look at. I do my own analysis of the silver market. I analyze others' work in terms of, for example, the Silver Institute or other groups that do silver research. And I'll look at that and base my opinion on their work versus what I'm seeing otherwise, perhaps, in the market. In terms of some kind of an under the radar play, I think that solar demand for silver. So we've talked about that. I would not consider that under the radar. But what I would say is that, again, there are concerns that if there's economic slowdown, that the demand for solar could drop off. Well, I can tell you that I've seen research that shows that if you go back 10 years or so, and you took the average forecast for how much solar installations we would have over the next 5 years, those average forecasts were off by 2/3, meaning that the installations were 3 times what those average forecasts were if you looked on the average every year for the following 10 years. So solar has really taken, I'm going to say, the energy market by complete surprise. In fact, in the US, just last year, for the first time ever, if you combine wind and solar is certainly the majority of the output between the two, they have combined, they have now surpassed coal for the first time ever. So solar has become very important. And here's sort of that under the radar aspect of solar is that there is tremendous demand for data. A lot of that now is being driven by the use of AI. One AI or ChatGPT search requires 10 times the energy of a regular old-fashioned Google search. So if you combine that and you combine the fact that the data that we're producing and we're storing in data centers is growing exponentially, these data centers, and we've seen news in the last few months that, you've got Microsoft that's turning to nuclear, is wanting to restart 3 Mile Island. You've got companies like Meta, which is parent for Facebook. You've got Alphabet or Google. You've got Apple. They're all turning to big, reliable sources of electricity. Well, besides nuclear, that is, I'm going to say green because there are no emissions and it's reliable baseload power. For me, the next most logical source is going to be solar because it's fast to build, it's fast to approve. The difference between solar and nuclear is that it has a bigger footprint, that's for sure. But once you've got that up and running, you are self-reliant and it doesn't take long to build that out. And sort of one last thing, if I may, about solar. The technology is changing very quickly. And so what we've seen as the bulk of solar power being produced has been a technology called PERC. And so there are 2 newer technologies that have come on following PERC. The next one is TOPCon, and then after that is HJT. Well, TOPCon, which already just in the last 2 or 3 years has almost replaced PERC to the tune of 60 to 70% of all new solar panels being manufactured now are being manufactured using the TOPCon technology. It's more efficient than the older technology, but it requires 50% more silver. And so even if the production of solar drops off somewhat, a lot of the consumption of silver is being compensated by the new technology. And then HJT, which will follow on from TOPCon, requires up to 150% more per solar panel than the older technologies. So as these technologies mature, we're requiring actually more and more for solar. So I think it is going to be a consistently big driver of silver demand in the market, and it's not going away by any means.
Wow, that is interesting. This has been a fantastic discussion with you today. Peter, I want to thank you so much for your time. I know our listeners will have really appreciated your insights.
Well, it's been my pleasure. Thank you so much, Claudia. I certainly would love to be able to talk again sometime soon.
Yes, we would love to have you back for another engaging discussion in the future. A big thank you to our viewers as well for joining us. I'm Claudia Merkert from BullionStar. I've been with Peter Krauth, and see you next time.